Welcome to FinEd, your favorite financial education channel, where I provide tips and insights on investing as a South African. In this video, I want to talk about unit trusts, a popular and tax-efficient investment option for South African investors. A unit trust is a medium to long-term investment that enables you to invest in markets that might otherwise be difficult to access. When you invest in a unit trust, your money is pooled with that of other individual investors, giving you access to a spread of professionally managed money market, bond, or equity instruments. Most unit trusts are open-ended trusts where there is no limit to the number of investors participating in the fund, and the number of units fluctuates only based on the supply and demand requirements of investors. Unit trusts are regulated by the Financial Sector Conduct Authority FSCA and the Association for Savings and Investment South Africa ASISA, which have certain requirements or mandates that unit trust management companies must follow. These include classifications based on where the fund is invested, what asset class it is invested in, and the main investment focus of the fund. When investing in a unit trust, you will purchase units at the time of investment, which represent your share of the unit trust fund. The price of the units is valued daily and is dependent on the value of the underlying investments in the pool. Unit trusts are an ideal medium to long-term savings vehicle. There are two prices quoted for each unit trust, a buy price and a sell price. The sell price or repurchase price is the price at which the fund manager will repurchase your units, while the buy price is the price at which you can purchase units. The difference between the buy and sell price is known as the initial charge and includes broker commission, fund charges, marketable securities tax, and VAT. Unit trust prices are fixed on a daily basis, often using forward pricing to calculate the day's price based on the previous day's close of business. When choosing a unit trust, it is important to consider the total expense ratio, which is a measure of the percentage of the fund's assets that are used to pay for the management of the fund. The TER includes management fees, operating costs, the liquidity costs, but does not include investor expenses or brokerage and transaction costs. It is also important to consider the annual management fee, which is a percentage of the value of the fund that is charged for management services, and the performance fee, which is a percentage of the fund's returns that is charged for outperformance. In South Africa, unit trusts are a tax-efficient investment option as they are exempt from capital gains tax, CGT. Investors only incur CGT when they sell their units in a unit trust. The CGT rate applicable to unit trust investors can range from 4.5% to 10.5%, depending on the investor's marginal tax rate. In conclusion, unit trusts offer a great deal in terms of CGT for South African investors. Unit trusts are exempt from paying CGT, and investors will only incur CGT when they sell their units in a unit trust. This allows investors to defer tax and plan their investments appropriately using relief measures such as the 10,000 Rand exemption and the offsetting of losses against gains. It is important for investors to understand the tax implications of investing in unit trusts and to accurately report any gains or losses on their tax returns. Overall, the CGT policy for unit trusts is transparent and in line with the objective of unit trusts as medium to long-term savings and investment vehicles. Thank you so much for watching the video. Please don't forget to comment, like, and share.